So, of course, it's not just the increase of interest rates, it's a general economic environment, and my summary will be focused on the European Union, because that's what most of the panel was about. And when you look at the European Union, it's impossible to ignore the war in Ukraine, the possibility of gas being cut off, the scenarios of recessions that would come with that. So the interest rate environment is part of a broader set of challenges, which is clearly a more difficult environment than what we have had, including during the COVID-19 years, which turned out to be a pretty good environment for credit, thanks to all the public support that went into credit provision. So in that environment, this is a challenging time for investors. Obviously, both equity investors and credit investors are facing difficulties to make money. I looked at it mostly from a policy perspective, because that's what I do for a living. And I think it's a very different policy environment and set of policy challenges compared to what we had in the previous episode, which was COVID-19. In 2020, the main objective for policymakers was to limit the disruption from the lockdown, from the reaction to the pandemic, and therefore it was to maintain credit to all companies without worrying too much about which companies are viable, which may be zombies, etc., because the shock, the nature of the shock was so unusual and kind of a one-off. Here we have a very different set of challenges where there is a need actually for reallocation of capital, for, if you will, creative destruction, and there was a remarkable degree of consensus on the panel on the fact that these forces of reallocation should be let go. Of course, there have to be safety nets and the usual social safety nets, but not corporate safety nets. The name of the game at this point is not to maintain the corporate structure intact as it was 2 years ago. And for me, that was the main takeover of the main takeaway of the panel. Some things that I see much more clearly now after this discussion, that policymakers should avoid fighting the last war. They should have a very different reaction function from the ones they had successfully 2 years ago when the virus came. But this is not a statement about the magnitude of the shock, because frankly I don't know, and I think it depends enormously on what I mentioned, the war in Ukraine, the gas provision by Russia. This is, to me, the number one factor that will impact the European economy in the next 6, 12, 18 months. And who knows what will happen there. What I'm saying is just, if there is a need for policy reaction, it shouldn't be the same reaction as last time. As to how much will be disrupted, I think there are reasons to be cautiously optimistic, because we have a sound banking sector, we have a corporate sector which is also in reasonably good shape altogether. Of course, depends on what, again, the shock will be. We don't have the same kind of bank sovereign vicious circle immediately around the corner, despite the recent fears in the marketplace, as was the case 10 years ago. And the reason for that is, frankly, we have a much lower perception, and I think reality, of redenomination risks. The Eurozone will not break up, no matter what. So basically, you don't have the same kind of contagion patterns that nearly broke up the Eurozone 10 years ago. What we have, of course, is some challenges in member states, but they don't take the form of the bank sovereign nexus at this point, because even in Italy, even in other countries which may be challenged from a fiscal perspective, the banking sector is not in such a bad situation at this point. So it is, of course, a pity that the bank sovereign vicious circle could come back, because we have an unfinished banking union, we don't have a capital markets union, we discussed that. We maybe didn't take advantage of Brexit as much as we should have done in terms of restructuring and reforming the European financial sector, but I don't think we will see a rerun of the Eurozone crisis anytime soon, and that's a matter of cautious optimism, which I think was pretty widely shared on the panel.